Hey, welcome everybody. I'm glad you could join us. Today's webinar is being hosted by Kolibri Global Energy, which is one of the companies in our small cap growth portfolio. The company's production increased by 68% year over year in 2022, another 77% in 2023. And all of this growth has been generated by their successful drilling programs in central Oklahoma. Based on the midpoint of their 2024 guidance that was just updated on September the 18th, the company's production should increase another 23% year over year using the midpoint of their guidance. I have been following the company for over 3 years now, and I just want to make a couple points before I turn it over to Wolf Reniger, who is their CEO. For its size, Kolibri has a lot of running room in central Oklahoma, and it's very low risk, high return development drilling locations. I refer to that as running room all the time, and it's in the central Oklahoma Scoop play, just to the southwest, I believe, of Oklahoma City. They have hold a big acreage block. It's over 17,000 acres, and most of it is held by production, which for you guys in the industry, you know that adds a lot of value to your property when it's held by production. But they have 170 potential drilling locations. 58 are listed as proved locations, another 60 probable locations. And I believe that's based on the third-party reserve report, year-end report done by Netherlands Sewell. And they're below the Caney Formation or the T-zone and the Sycamore zone, which have not been included in their year-end reserve reports yet. So we'll see about that maybe in the future. But based only on the proved reserves in their 12/31/2023 reserve report, 32.4 million BOE, about 75% light oil. The company's PV10 net asset value was over $12 based on their June 30th, 2024 balance sheet. It should report more proved reserves at the end of this year based on this year's drilling program. And about 92% of their revenues in 2023 are coming from oil sales at an average realized price of around $74 net of differentials and the cash settlements on their hedges. Oh, that was last year. I'm sorry, on 2023. And they received 1.5 million in settlements on their hedges. But key to my valuation of this stock is that they have steady annual production growth. I mean, our Sweet 16 and small cap growth portfolios are basically for the growth, building the value of the company's proven reserves and production. And it's funded by operating cash flow. They have lots of low-risk development drilling locations and near-term potential for a shareholder return program. So our speaker today is going to be Wolf Reniger, the company's president and CEO, and also joining us is Gary Johnson, the CFO. Wolf brings over 36 years of conventional and unconventional E&P experience at the company, most of the time in senior management positions. Prior to joining Kolibri, he served executive vice president of Bankers Petroleum Limited up in Canada and president of its wholly owned subsidiary, B&K Petroleum, which was spun off in 2008, which is what created Kolibri. With an extensive operations finance background, he has been at the forefront of B&K Petroleum's acquisition of unconventional gas projects and on an international scale and development of the company's Tishomingo field in central Oklahoma. He holds an economics degree with an emphasis on computer science from the University of California. Then Gary Johnson, he's the company's CFO. He is a CPA and brings over 30 years of accounting and finance experience, 20 years in the energy industry to the company. So, and his career includes roles with Occidental Petroleum Company, which is a big Oxy. You all know that. He is a graduate from Loyola Marymount University with a Bachelor of Science in Accounting, and he also holds an MBA from Auburn University. So with that, I will turn it over to Wolf to do their presentation, and then I'll come back for the Q&A. Now, if you guys that are on the call, if you want to ask a question, you can type it into the chat box, and I'll read it at the end of his presentation. So Wolf, take it away. It's all yours.
Oh, thanks, Dan. Appreciate it. Thanks, everybody, for joining us here today. Here's the forward-looking info, the disclaimers, and non-GAAP measures. These can all be found on our website on our corporate presentation. So Kolibri, as Dan had said, low debt, continued cash flow growth, fully funded for the year. And one of the things that really differentiates us is the amount of proved reserves that we have in the proved undeveloped category. So 24% of our reserves are in the proved developed category. As Dan mentioned, about 32.4 million BOEs in the proved from our year-end 2023 reserve report. So that leaves 76% of those reserves to be developed. And I'll show why we think there's a big disconnect between where we're trading on our stock value right now versus what our asset value is in the next slides as we go forward here. Proved probable reserves of about 54 million BOEs. So we think we have a good management team. I think we're showing that in how we're executing. Great board as well. Focus on strong corporate governance as well. Netherlands Sewell does all our reserve reporting, and focus on HS&E, of course, as well. So where we are, let me move this out of my way here. There we go. Ticker on the NASDAQ, we listed on NASDAQ last year in October, KGEI. Before that, we were only on the TSX under KEI. So share price trading around 320 US right now gives us a market cap of about 115 million. Net debt end of last quarter was 33 million. Looking to keep that about in that range or a little bit lower going forward. Gives us an enterprise value of, call it 150 million with a low debt to adjusted EBITDA. So why is that relevant compared to our reserve value? 32.4 million BOEs at the end of last year gives us a value of 483 million per Netherlands Sewell, the third-party reservoir engineers. Proved probable over 700 million. So versus our market cap of 150 million US, right? Of enterprise value, I should say, not market cap, because it includes the debt. Big disconnect on that in general. So we'll go into some details in there. So we are located about halfway between Oklahoma City and Dallas, just outside of Ardmore. We originally drilled for the Woodford Shale out here. The Woodford was only about 15% oil. The balance was natural gas and natural gas liquids. We had about 12,500 acres out here. Exxon was buying out everyone else around us. They did buy out everyone else around us, and we held out for the last ones. So we ended up selling to them for 147 million, but we kept our rights for this shallower formation called the Caney. It's only about 350 feet shallower than the Woodford, but as the Woodford was only 15% oil, the Caney now is 74% oil, with a balance of 16% natural gas liquids. So on a liquids basis, we're 90% roughly liquids. Fluctuates a little bit depending on where gas sales go, because what we do is we sell our gas and natural gas liquids. Exxon markets it for us. They have the gathering system out here, so we pay them a compression and a gathering fee. And then they end up selling the natural wet or the wet gas, which gets split up into NGLs and natural gas. And sometimes it's a little higher and sometimes it's a little lower. They market things to maximize the revenue, and their marketing department is, quite a bit larger than ours. So we get the same pricing that they get on their stuff. Going forward here for the year, development keeps going. As we mentioned, we're fully funded. Forecasted production growth 14 to 33% over 2023. In the second quarter of this year, we drilled 2 wells called the Nickel Hill wells. Those were on the far west side of our property, actually, and those were actually possible locations. They weren't even in the proved category. So third and fourth quarter, what's going on? Longer lateral wells. We've up till now drilled, these are all horizontal wells, I should mention. Up till now, we've only drilled 1 mile laterals. So these 3 wells that we just finished drilling that were done under budget are 1.5 mile laterals. So now we're scheduled, I should say, in the process of completing these longer laterals now. And the reason that's significant is from the same wellbore, if you can access more of the reservoir and your incremental cost for adding that amount is less than drilling a complete new well, then you're more efficient in what you are doing, getting oil out of the ground cheaper, and thus you make more money. You have a higher RRR. That's what we're looking to prove with these first of our longer laterals out here. So that's a big catalyst for us. If we can show that these wells can be even more economic than what we've been doing in the past, then that can be a big reevaluation of the whole property. Forecast for the year, 2024, 32 to 3,700 BOE, increasing 14 to 33%. Revenue, 57 to 62%, a 13 to 23% increase. Adjusted EBITDA, 43 to 48 million, which is a 10 to 23% increase. Adjusted EBITDA, as Dan was mentioning earlier, our growth has been nice. We were 6.5 million in 2021, 25 million in 2022, up to 39 million in 2023, and we're looking at 43 to 48 million for 2024. So that 43 to 48 million is based on a capex of 33 to 38 million. And with that, you can see we'll hopefully have some money left over. And that's why the board authorized a shareholder return policy. So we're looking to buy back some shares, and that was approved as of September 23rd of this year. Production, showing you that growth as well, just on a quarter by quarter basis. Nice steady growth, increasing. Net operating income, same thing, nice growth. And the red line is our price of oil. So you can see even as the price of oil has come down from the peak, our growth on the net operating income is still going up. So the field itself, we have all the infrastructure in place. Because of all those old Woodford wells that we drilled, there's a gathering system across the whole field. And we had sold our 1/3 of that gathering system to Exxon. As I mentioned earlier, Exxon markets and sells all our gas for us. So we don't have a big infrastructure that we have to build out here. Oil is all trucked out of here. So we get WTI less about $1.85 trucking. So there isn't a big differential. That's been very consistent over the last 4 or 5 years. So I know some basins obviously have big differentials where they change a lot. We don't have that issue. As Dan mentioned, also 170 total locations that are booked by Netherland, Sewell, 58 probables, 60 or 58 proved, 60 probables, and the balance in the possible category. That was at the end of last year before we drilled these wells. And as I mentioned, so these wells that we've been drilling are on the west side in that possible category. So we'll have more proved that slips over into the proved category. And we'll see how much Netherland, Sewell gives us credit for, but it should be an increase to our proved reserves. We had 32 wells on production, bringing another 3 on here. And as Dan also mentioned, we have 99% of our acreage is held by production. And then we have some additional upside from the T-zone. We did drill a couple wells into the T-zone last year, and we proved that the T-zone does work. We did have some interference coming up into the Caney, so we decided to just focus on the Caney right now. Once we've developed the Caney, then we can come in and drill T-zone wells where you can re-stimulate the Caney basically if you happen to frack up into the Caney a little bit as well. This is a kind of a historic estimated oil recovery. This is by Netherland, Sewell for each proved undeveloped location on average what they assigned for each of those locations. And you can see as we were developing this field, as more production was coming out of these wells, their estimates each year were increasing for how much each well was going to produce. So that shows the quality of the reservoir. So, you know, some other reservoirs in general, when you drill them, and after a couple of years of production, you realize they're declining more than they thought. In our case, they were declining less than they thought. And so it's really held in there. And then these have stayed about the same since then. So I didn't update this to the graph. I mentioned that we were drilling 1-mile laterals. So you can see how we've improved on that. So we're always looking for constant improvement in what we do. 2016-17, it was about 30-day wells to drill and complete. That'd be drilling down to 8,000 to 10,000 feet and then going horizontally another 5,000 feet or so. So you can see that we were at about 30-day wells. We changed some things, improved some things. In the early 20s, we were drilling these wells for about 22 to 20 days roughly. And then last year, we made some other changes to try some new things. And the last couple of wells of last year and the first 2 wells of this year for 1 mile laterals were in 12-day period. So drilling faster, costs come down. So in 2023, our forecast was for $7.2 million wells, and we've dropped that cost for the last 4 wells down to 5.5 million each. Again, these were for the 1 mile laterals. Now, our first 3 1.5 mile laterals were drilled in 14 days. So that's only an extra 2 days or a 50% increase in our lateral length, which is a great start for us to be able to drill these wells and complete them cheaper and more efficiently. Talking about our value of our reserves, the enterprise value versus proved reserve value. This is a comparison to other Canadian companies because our reserve report from last year was only done in Canadian standards. It's in the NI 5101, it's called. And the only difference really is the price deck. So they use kind of a forecast price deck versus just using the average from the last 12 months of the last day of the month, which is what happens in the SEC case. So I can't compare apples and apples if I'm looking on the SEC side of other companies. So what we're looking at is some of the Canadian operators, some of them have US operations, some of them are just Canadian operations. But this is as close as we can get to our peers. So they're trading on an average of 54% of their net asset value. You know, our net asset value is somewhere around 100% on the proved reserve side of things. At the end of last year was about $13.50. 2P was about $20. So we have a lot of running room. But just to get up this average, we're trading at 22% when the average is 54%. And I'll go through and show you why I think we should actually be trading higher than the average. One of those things is our operating netbacks. In comparison to these other peers, our operating netbacks, so how much money we're making per barrel of oil when we're pulling it out of the ground, based on last year was $44 a barrel. G&A has been coming down nicely. OPEX, our operating expense per barrel, so how much it costs us to lift each barrel out of the ground, we were at $5.22. So the companies that were a little less than us were natural gas producers. So natural gas flows out of the ground completely, so you don't have lifting costs. But we're obviously very efficient in what we're doing in our costs for getting those out of the ground. And these are from the fourth quarter financials, by the way, from 2023. Now here's a comparison to SEC, other peers. List of the companies are down here. This is from the first quarter of 2024. We're up here in the upper end of the best operating companies around. So we're actually doing a little bit better than some of the other really good operators out here at $50 a BOE or netbacks. And then this goes into just showing what our net revenue is, very similar to some of the other graphs I had earlier, but just kind of emphasizing the point how our yearly net revenue is growing nicely and what our expected is for this year. Dan was kind enough to go into our backgrounds here for myself and Gary. Dan Simpson, our director of engineering, he joined us last year. He's been doing some consulting work for us on the reservoir side of things for a number of years. But he has over 30 years of experience. We made some changes last year, by the way, when we brought him on. Has lots of experience all over the world and has been doing a great job for us here at the company. Alan Hemme doing a great job for us on the geology side of things. Chairman, Evan Templeton, he is ex-Jefferies high yield leveraged loan market as a energy strategist. So he has lots of oil and gas experience on the US side of things. Doug Urch has been with a number of oil and gas companies over his career. He's head of our audit committee. David Newhouser runs Livermore Partners out of Chicago. So lots of experience on the public company side of things, where he's a large shareholder of Kolibri. And Leslie O'Connor, lots of experience on the reservoir engineering side of things. She ran the offices for MHA Petroleum Associates and Sproul for their Denver office in the US. And with that, just kind of summarize again, our ticker symbols right up here, KGEI on the US side of things. Proved reserves, 32.5 million, 32.4 million, 2P reserves of 54 million. low debt to EBITDA of less than 1, have 15.8 million available on our line of credit. I didn't mention, but we do have a $50 million line of credit with Bank of Oklahoma that we use for working capital purposes. And catalysts are, these longer laterals that can make a significant difference in the valuation of the property and the rates of return that we get on our wells, which are already, doing great up till now in the 1 mile laterals. And then we instituted the shareholder return policy of starting to do some share buybacks for the company. So with that, that's the entire presentation.
Okay. Well, I tell you what I'm going to do. Harry Van Neck is on the call today, calling in from the Netherlands, right, Harry?
Yeah, right.
Yeah. So he has a few questions that are kind of on his details for his forecast model. So Harry, why don't you go ahead and ask those, and then I've got some questions also.
Yeah, if I can start. Thanks for the presentation. Very enlightening. Very much appreciated. My main question is, what took you so long? If I look at your proven reserves, you have been sitting above 30 million barrels for the last 5-6 years.
Right.
And you've been early sitting at about 1,000 barrels a day, only kicking it off in Q2 2022. Why haven't you started 3 years, 4 years ago?
There's ups and downs in oil prices, first of all, but we went through a period where we had a split board where part of the board just wanted to try to sell the company, part of the board wanted to just keep drilling wells. So we were in a situation where we didn't do much of anything for a number of years. And then we kicked it off back 3 years ago and started to drill. So really we had pretty much a reset, which is why I also changed the name of the company to Kolibri from BNK Petroleum to say, look, we're looking to grow the company. We're looking to prove up what I and a number of the board members and some of our large shareholders felt that this company can be worth and grow into. And that's what we've demonstrated over the last couple of years.
Okay. So are you planning to continue growing, or are you now thinking more about returning money to shareholders? You have the potential to double your production if I look at your reserves.
Correct. So
Easily.
it's going to be not a decision made by just management, obviously, but what we're going to recommend is a balance between the two. Doing some returning of capital to shareholders, probably not the growth quite as strong as it has been, but continued growth with extra cash going back to shareholders. We do have shareholders that have been with us for quite a while, some of the larger shareholders too. And I'm sure all the shareholders would like to see some return of capital to them. That's what I'm hearing from the market as a whole, including our larger shareholders.
So you don't want to borrow a bit more money and go a bit faster?
Not at this stage. At this stage, what our recommendation is to continue using shareholder cash flow, or the cash flow from the properties, using debt a little bit, but not getting over leveraged, and still continuing to growth, but have some nice returns.
Yeah.
Hey, Wolf, I noticed on those 2 wells you drilled earlier this year, you had a partner on that, right?
We did. So yeah, and you can guess who it is, considering Exxon is all around us. So they have that entity has participated alongside with us on that well. They had the rights to do that in that acreage. Most of our wells, most of our locations, we have 97 to 100% of those wells.
Okay.
But in that section, as we were stepping off to the west, we felt like it made sense to, it was a little bit of risk there, obviously, when you're stepping into a possible location, as much as we'd like the geology. So we thought that the first couple of wells, we don't have to pay 100% of it. That kind of makes sense.
Well, see, that's what I was thinking. On some of this acreage, it's kind of outliers. Yeah, maybe you get some partners on that, and they can pay a disproportionate amount of the drilling cost or something to prove up some of those areas.
Right.
Yeah.
Yep, you are correct. Yeah, we still have that acreage way off to the east that has 0 reserves attributed to it. So that at some point in time, we will have to step over there and test that, and we will definitely keep that in mind as well on what sections we pick.
Okay. Go ahead, Harry.
I have another clarifying question. You mentioned you're trucking oil. Now, I assume that's stabilized oil for export from the area. It's not the oil within the field to the separators and the likes like that.
Well, yeah, we separate it down to having less than 2%, what they call BS&W. So, and then it's sold off to the refineries.
But you're exporting your gas by pipeline, I assume?
Yes, the gas is all, we're never more than a mile away from any gathering system here. So all we're doing is selling the wet gas off, and then Exxon takes care of that, and then it sends it to multiple different cryogenic plants where they separate out the wet gas into, 1,000 BTU gas, and then the balance for NGLs, natural gas liquids.
Yeah. And those are exported by truck as well, the NGLs?
You know what? That's off of our property, so that's
Okay.
whatever they do with it. So that's most likely pipelined, but
Yeah.
yeah, it's from wherever the cryogenic plant is. And like I said, they go to multiple different plants, so we're not in charge of that part.
Okay. And you said you want to balance yourself between shareholder returns and further investments. Do you have any target of how much of the free cash flow you want to return to
Um,
shareholders, or is that yet to be set?
yeah, it's yet to be set. So we'll make our recommendation to the board, and we'll have a discussion on that. And then when we put our forecast out for the 2025, that'll be in there.
Well,
But are
most
they,
likely a
they're,
function of oil price as well.
yeah, yeah.
Yeah, always is, always is.
I'd say these oil prices are. I think the volatility of the oil price is what's keeping a lot of investors out of this. I think that,
Yeah, I do
like
too.
you said, these companies are trading at like 50% of their PV10 value of just their
Right.
proved reserves. You're not the only one. I mean, a lot in
Mhm.
the Canadian companies, they're even lower. It's
Right.
crazy. When I was doing business development for Hess, if we could buy a company for 4 or 5 times cash flow, we were all over it. So
Right.
anyway, let's see.
Yeah, and they're getting valued on their PDP reserves, not even on their full proved reserves, right? So
Yeah, yeah, it's just
yeah,
crazy.
and that's usually what happens in a crash, in an oil price crash, and then it
I know.
recovers, and then right, and this time it's taken a whole lot longer. But like you said, the volatility is scaring people, and I think people are worried that we can't make money at $70 oil, and we
That's
definitely
absolutely
can.
true. Yeah, I was on an hour-long webinar with U.S. Energy Development. They're one of the largest private upstream companies,
Mhm.
and I could just tell from the questions they just believe that if the oil price goes to 70 or 65, that these companies can't make any money. And
Right.
you're here looking at a net back of $50. Good Lord. I mean, that's good stuff. So, can you tell me what those 2 wells that you completed, what are they producing about now?
You know what? We haven't disclosed that, so I can't
Oh,
just
okay. Okay.
selectively disclose that. Sorry, I just have to be careful about that. But we used to have decline curves up there, and you can see that if you still see some of our old stuff,
Uh-huh.
they're tracking quite well.
Yeah. Well, I mean, I'm just using my forecast model, which is just based on the midpoint of your production guidance for the year, which is 3,450. So you'd have to average about 3,500. So 3,600 to get to that for the next 2 quarters. And I'm assuming that most of that growth is going to be in the fourth quarter, right?
Yeah.
Yeah. It's got when you
Yeah.
complete these 3, and they should all be completed as sales by mid-November or something.
Yeah, I'm hoping early November that we have them
Early.
all
Okay.
on and
Okay.
going. So we'll see how that goes. So,
Okay. Okay.
so we're hoping for the best.
Harry, did you have another question? I didn't.
No, I'm done.
Okay.
We've covered my points.
Okay. Another thing I want to ask, there was a pretty significant drop in your natural gas and NGL prices from first quarter to second quarter. Do you expect what caused that, and do you expect a rebound in those prices at all?
You know what? That's again, it's really hard for us because Exxon does
Yeah.
what they do with it, and sometimes we'll have a lot more natural gas being produced or coming out of our wet stream,
Yeah.
and sometimes it's more natural gas liquids, and so they try to optimize it for where they're making the most money on it. So if like natural gas liquids prices are really low,
Mhm.
you'll see them selling more gas. They'll switch the product streams a bit. So it's really hard for us to forecast. So a lot of times it drives Gary and our accountants nuts because of
Your accruals, I
we
know.
have, well, the accruals, right? And then,
Yeah.
when it's way off. So you sometimes have pretty significant adjustments on that side of things. Luckily, as you mentioned, that's not what makes us the money.
Mhm.
So
Yeah.
even
So
though
I mean,
they're
92, I think it was 92% of your revenues last year were from oil sales. So it
Yeah,
really isn't
usually
that
it's in
big
the
of a deal.
high 80s, low 90s. That's correct.
Yeah, but I mean, I'm getting more optimistic about natural gas prices, so maybe we'll get some stuff going on that. So
And
we'll
I
see.
can add to that as far as the natural gas prices, we were getting the same prices that XTO is getting. So that's, I mean, it is what it is,
Yeah,
but at least we
it's
know
just
that.
what you get, right? Yeah. Okay. What else we're gonna have here? Let's see. I'll read some. We got some in. Oh, can you talk about your hedges? Bill asked about hedges. What's hedged? How long? What percentage of your production is hedged?
I can handle that. So we're the BOK financial requires us to hedge certain level. So we're at our current level of debt, we have to hedge 50% for our production for the first 12 months, and then 35% for the 6 months after that. So we're about roughly 60% hedged for the third quarter, and probably about just under 50% hedged for the fourth quarter because the new wells are coming online. And that's those hedges are costless collars, so they're pretty wide band, about 64 to 87. So it's a pretty wide band there that we can hedge, so we don't have that much impact. When it stays.
Yeah, I was going to say I was just looking at the table. I got your hedge table up here on my forecast model, and the floor and the ceilings are so far apart, it's not shouldn't really impact the price at all, does it?
Well, unless obviously prices crater or they just go up. But yeah, right now we're good as far as impacting.
Yeah, the only thing so with the oil price going down at the end of the quarter, you'll have a pretty big mark-to-market adjustment gain, I would think, on the oil hedges, right?
Not
well
too
because
much,
we're
if it stays within the band, our volatility is a lot less on the mark-to-market.
Because of the band. Okay,
collars, because before when we were doing fixed price swaps, we did have some pretty significant swings, but now those should be lessened because of the collars.
Yeah. I'm like in my forecast of your realized price, I'm not even considering them at all because I think the price will stay between the floor and the ceiling the whole way. So
yeah, right. There's not much impact then if that's the case.
Yeah, and when on your EBITDA forecast, I think you're in the 43 to 48 EBITDA. What oil price are you using in that?
75.
For the 75?
Okay. For the out years.
Okay.
That month, sorry. That month.
Okay. Let's see. Okay, a year ago. So share price crashed from 472 a year ago, and I mean, we know you had some problems with your completion crews that were kind of outside. Why don't you go through that, and are we past that now? Let's hope.
Yeah, I mean, we had a couple things. We had one, we drilled, as I mentioned, those T-zone wells, right? That one T-zone well kind of impacted, it fracked basically up into the Caney. And there was an area that was a little bit more fractured naturally. And so when we fracture stimulated the T-zone, which is right below the Caney, it fracked up into the Caney and then it went out. And so we impacted wells that were further out than we had ever impacted before because we shoved so much water into a small area. And so that affected overall production. And then later on, we actually changed our forecast a bit to account for these longer laterals. So, we were accounting for longer time to drill them and longer time to complete them. So when things come on later in the year than you originally anticipated, it'll drop your average down for the year, right? So that was where the adjustments that we made. Nothing that is anything that we see any issues with going forward at all. But,
was it a problem? It was didn't the completion crew, they showed up late, didn't they?
Yeah, I mean, we do have, there was a little bit of that as well. So
yeah,
and that just happens in this business, right? So that they get stuck on something else, they have issues with the previous operator wherever they are, and then it takes them a little longer to get to you. So it was a combination of a couple things that came together at the same time.
Yeah. Well, I think you mentioned in your presentation, his second question is any insight on how this might recover? And you said, well, if these new 3 wells with the longer laterals come on strong, you have real good IP30s or 60s or whatever, you should get more credit for those wells.
Yeah, without a doubt. And what we're hoping for is, we drilled the first step was drilling the wells, right? And we had estimated actually 20-day wells on this, and we drilled them in 14, so that saves money. So if the completions go well as well, right, then the intent is to can you drill a 1.5 mile well, so 1.5 time well, for less than 1.5 time what it was costing you on a 1 mile lateral?
Yeah, right. Yeah.
And so we're hoping that these wells come on for, somewhere between 1.35 to 1.5 times what a 1 mile lateral does.
Hmm.
And then, if your cost is down below that, you're making more money and you're more efficient and you get a better rate of return. So,
Yeah.
and then the value of the property goes up. So
Well,
it was
and
a
also,
hard decision for us to go with these 1.5 mile laterals because we did drop our forecast down a little bit and we knew that was going to be a little negative in the market.
mhm,
But sometimes you have to make those kind of decisions because it's the best thing longer term for the property, even though it might be a negative in the short term. So
yeah. And also you had to shut in some wells longer than you thought because those completions took longer, right?
that was related to the getting the frac hits also from the offset wells that were further out. So
Yeah.
shut-in
Okay.
times were about the same, but the impact on the offset wells was a little bigger than we anticipated. Because of that extra water that came up into the Caney.
Yeah. Can you like focus your drilling program to like drill in different areas further apart so you wouldn't have to shut in wells, but then you would like prove up like the entire block. You could prove up the whole entire block doing that.
Yeah, I mean, we kind of take that into account as far as when we shut in wells, where we shut them in. Like what we did was, remember, we drilled those 2 Veland wells as well that we haven't completed yet that are sitting there as ducks.
Uh-huh.
And the reason that we didn't complete those was we felt it was best to drill more wells around that area so that it has this impact only once on the existing production that's there.
Hmm.
So we just decided to be a little bit more cautious after we had that impact last year.
Okay. Okay. Well, I think we're in a much better situation. If you
Oh, yeah.
can jack production up to 4,000 barrels a day or something at the end of the year, that's going to look really good. So, okay. He also asked, you mentioned share buyback. Is that kind of what they're, I would think, because you guys don't have that many shares outstanding anyway, I would think just paying dividends would be a more preferred way to go, but I don't know.
Well, we decided to start with some share buybacks. So look, we kind of get into a situation where we have more and more cash coming in for next year, right? Assuming everything goes the way we're anticipating. And
Yeah.
so we can look to do that when we're in that situation, when you want a longer term plan for your decision has been made as far as how much you're putting back in the ground versus how much you're returning to shareholders.
Yeah.
So we felt
Yeah.
this was a good start to just kick it off with. And some shareholders have been in there a while, and we can show some support and get some shares back for a lot cheaper than where we're at. And people are
Yeah.
rattled because oil price volatility.
Well,
Then that's a win.
I'll bet you that 2/3 of the companies that I follow have active share buybacks, and some are pretty aggressive. Some of them, they're buying back 8-10% of their outstanding stock. They got approved. There's some pretty big stock, and I don't think it gets the credit it deserves in the market. That's what's incredible to me, because you're taking shares out of the market and you're increasing your production and stuff. Your share price should be going a lot higher. Anyway, okay, next question from Gerald is, other than Exxon, is anyone else in the area aggregating acreage and production? Is there a lot of M&A activity going on out there?
In the Scoop and Stack, there are M&A activities that are going on. I mean, immediately around us, Exxon has 280,000 acres around us. So we're kind of in that
Yeah.
block where they're at. So,
Okay.
but there is some activity going on in other parts of the mid-continent for sure.
Yeah. Okay, next question says, can you make your reserve reports available so that we can run our own DCF analysis? Discounted cash flow? Yeah.
Just what's out there, you can get quite a bit off of our F1 reports that we put out there.
Okay.
And those, you should be able to find those on our website as well.
Yeah, and also on CDAR too. I mean,
Yeah.
Okay. Oh, here's a question for Harry. Where does KGEI rank in your list of 82 companies?
83 nowadays. It's 9th as of yesterday.
9th? Okay.
Yeah, so pretty good.
Yeah, pretty good. Well, why don't tell everybody, the listeners, how you rank the companies.
Oh, that's I need half an hour for that. I don't think this is the right place for that. But I look at a lot of parameters, and I basically do a discounted cash flow. But I look for my discounted cash flow at what is actually impacting, what are the uncertainties. And,
Uh-huh.
yeah.
Yeah, but when I look at Kolibri, I think there's two ways you can go, and I know you guys longtime shareholders, and they're wanting some stock buybacks and dividends and whatever. But the other way would be get more aggressive. What's the value of well locations that are 10 years away? So you got all these and on the 1 mile long laterals, if you get production in line with the type curve, aren't those wells paying out in like a year?
Yeah, depending on your price curve or what we're
But
using
it's
for
$75
prices. Yeah.
oil and it's $50 net
Yeah.
tax. I would think it'd be
Yeah,
paying out really
it's
fast.
somewhere between 12 and 14 months, probably.
Yeah.
Just guessing. So.
See, that's for somebody like me. If we thought could get wells pay out in 3 years, we thought they were really good wells. So when I see 1 year payouts, I'm just like blown away from that. Anyway,
it really deserves a bit more aggressive approach as well. Eh? If I was your economist, I would advise you to go a bit faster.
Right.
Yeah, because I would say you want to if you want to make the company really attractive as a takeover, prove up a whole bunch of the acreage and get a lot of PV10 value out there, and somebody's going to start taking a look at. I would think. Yeah, I can't believe you don't have some unsolicited offers coming in the front door with that reserve report. Anyway.
Well, that was also one of the reasons that we drilled those possible locations last year, right? So on the west, to get the west side in there.
Yeah. Now is Exxon doing much out there? They're not drilling many gas wells now, are
they? No, they're not doing a heck of a lot. So yeah, they drilled some wells in the not too far away in the Marietta Basin to the southwest of us, but those are really deep, 14 to 15,000 foot TVD, true vertical depth wells that they're drilling 1.5 to 2 mile laterals out there.
Yeah, is Continental pretty aggressive out there?
They are to the northwest of us. And
they're drilling. What are they in the Springer or Sycamore formation or something?
Well, you've got a number of different formations out there. Yeah, the Caney itself turns into the Merrimack, which is more of a carbonate up that way. So you've got the Springer that they've drilled wells in. You've got Woodford production up there, and you have a lot of different zones that come in. Things vary as we go across the whole area as a whole. We're kind of unique in the Caney in that it's so just a true shale. It's a very high net to gross shale. We don't have a whole lot of carbonate. We don't have a whole lot of sand stringers in there that some of these other plays have had high IPs, but they fall off quickly because everything has been migrated in. So that's kind of what makes us unique out here.
So these wells have pretty not really steep decline curves in. That's good.
Yeah, I mean, it's still for shale, it's still steep, right? Compared to conventional, let's be clear. But yeah, they've been far less steep than some of these other plays in the area.
Yeah. Well, anyway, Harry, got anything else?
No, I'm fine.
Okay, good. Thanks for doing this, and we'll get you back up to Houston for a luncheon or something one of these days. But I'm going to make some notes here, and then we will republish our profile on the company here next week, I think, and go from there. So interesting times we have here.
Well, you got to keep doing your business the right, and kind of sail through these highs and lows.
Yeah, well, we definitely have
keep doing that.
Geopolitical risk. Geopolitical risk to supply is like going crazy.
Yeah.
So interesting. All right. Well, thanks a lot. We'll go ahead and end it there, and we'll send out the link to the recording to all of our members, and it'll be up on the YouTube in a couple of weeks for anybody to look at. So I imagine it'll get quite a few views. Again, thanks for doing this. So cut it off there, Sabrina.